US jobs data shock? What ADP just revealed about the economy? The calm before the storm. The job market is strong. That's what the headlines keep saying. That's what the politicians want you to believe. And that's what the markets are still pricing in. But what if they're wrong? On July 2nd, a single report, often ignored by the mainstream, might give us the clearest signal yet that something is breaking beneath the surface of the US economy. That report is the ADP non-farm employment change, and it's not just a number. It's a trigger. While everyone waits for the official non-farm payrolls report later in the week, ADP offers a first look, a preview into the state of private sector employment. And this time, it may not be what investors expect. In fact, if you know how to read it, this report can tell you a lot more than just how many people were hired last month. It can reveal whether the soft landing narrative is still alive, if the Federal Reserve has lost control of the cycle, and how gold, the dollar, crypto, and stocks could all be about to move in opposite directions. Because this isn't just about jobs. It's about trust in the system. And in today's economy, trust is everything. In this video, we'll break down what the ADP report really measures and what it doesn't. 3 possible scenarios, and how each could shake global markets. What smart investors and traders are watching right now behind the scenes. If you're tired of surface-level headlines and ready to go deeper, to understand what really drives price, power, and panic, then this video is for you. So go ahead, hit like, subscribe, and share this video with someone who still thinks job numbers don't matter. Because on Money Minded, we don't follow the noise. We follow the money. Let's get started. Chapter 1. What is ADP and why it moves markets? If you're not a full-time trader, you might have never paid much attention to the ADP employment report. It doesn't grab front-page headlines like the official US non-farm payrolls. It's not shouted about on CNBC, at least not until it surprises. But here's the truth. For professional investors and global institutions, ADP is often the first domino in a week that can shake markets around the world. So what is it? A private window into the US labor market. ADP stands for Automatic Data Processing, one of the largest payroll processing firms in the world. Each month, they analyze anonymized payroll data from over 25 million US employees, giving a powerful and timely insight into what's actually happening in the job market before the government releases its own figures. In short, it's the first credible look at how many jobs were created, or lost, in the private sector last month. And in today's economic environment, that one data point can do more than move a market. It can shake entire asset classes. Why traders watch ADP closely? Here's why the smart money watches this report like a hawk. It sets expectations. The ADP number often comes out 2 days before the government's official non-farm payrolls, NFP. While the correlation isn't perfect, it gives traders a directional clue. It moves yields and the dollar immediately. If the ADP report shows job growth slowing sharply, bond yields tend to fall, pricing in future Fed cuts. The US dollar drops, and gold often rallies. A strong number, on the other hand, sends yields higher, the dollar stronger, and risk assets weaker. It plays into the Fed's data-dependent narrative. Ever since the Fed pivoted away from forward guidance, they've emphasized, we'll act based on the data. That makes every high-frequency data release a landmine, or an opportunity. Markets move on surprise, not just results. What matters is not just the number itself, but how it compares to expectations. A print of plus 150,000 jobs might sound strong, but if markets expected plus 250,000, it's seen as weakness. This is what most retail traders don't understand. Markets trade the difference between forecast and reality, not the number. Why this month's ADP matters more than ever. In July 2025, the ADP report has outsized significance for one simple reason. The market is at a breaking point of narrative. For months, Wall Street has been pricing in a soft landing, an economy that slows without crashing. At the same time, inflation has proven stickier than hoped. The Fed is stuck. Too much easing risks inflation, but too much tightening risks a crash. This means the labor market, and any signal about it, becomes the tiebreaker. A strong ADP report will be seen as validation of economic strength, delaying rate cuts and potentially crushing hopes for a liquidity-driven rally. A weak report, however, may ignite recession fears, but also revive expectations for monetary easing, pushing gold and crypto higher. It's a damned if you do, damned if you don't moment. But beware, ADP is not gospel. Let's be clear, ADP is a useful guide, but it's not infallible. The methodology changed in recent years to better align with NFP, but discrepancies remain. Sometimes, ADP shows strength while NFP prints weakness, and vice versa. The sample size is large, but doesn't capture government jobs, gig workers, or informal labor. That's why the smartest traders don't just trade the number, they trade the reaction. They ask, how is the market interpreting this? They track bond yields, Fed fund futures, DXY, and gold within minutes of the release. And most importantly, they look for divergences, moments when price and narrative break apart. A signal for those who watch closely. In a normal market, the ADP report might be background noise. But in a market running on fragile confidence, conflicting data, and delayed reactions, it becomes a flashlight in a dark room. If you're just getting into macro trading, this is your edge. While most investors wait for the main event NFP report on Friday, ADP is the opening move in a chess game that could define the week, and potentially the month. In the next chapter, we'll break down 3 scenarios that could unfold based on the ADP data, and how each one could reshape the short-term outlook for gold, the dollar, crypto, and equities. Before we move on, hit like, subscribe, and share this video if you want more real macro intelligence, right here on Money Minded. Chapter 2, Scenario 1, Weak ADP, Job Growth Below 120,000. Imagine this. The ADP report drops, and the headline number is far below expectations. Instead of a solid 200,000 jobs, it comes in under 120,000. The financial media starts spinning it, seasonal factors. Temporary softness, don't overreact. But traders know better. A weak ADP number isn't just a statistical miss. It's a signal, and potentially a turning point. The first question to ask is, what does this really mean? In macro terms, weak job growth suggests one thing above all else: demand is drying up. Businesses are holding back on hiring, which often precedes broader cost-cutting. Investment freezes, and eventually layoffs. This is where the labor market starts breaking from the top down. It's not that everyone is getting fired, it's that businesses are quietly stopping the hiring train. And here's the strategic layer. The Federal Reserve has built its entire soft landing narrative on the idea that the job market remains resilient. A weak print here puts that story at serious risk. So how will markets react? First, look at the bond market. A miss that wide would likely push yields lower across the curve, especially at the short end. Traders would immediately begin pricing in a higher probability of interest rate cuts, perhaps even as soon as the next FOMC meeting. The Fed may still talk tough in public, but in the background, the data will be forcing their hand. Second, the US dollar could take a sharp hit. Lower job growth implies lower interest rate expectations, which makes the dollar less attractive to global investors. Currency traders don't wait for the Fed to speak, they respond to implied policy changes. And this kind of print would suggest a significant shift in momentum. Then there's gold. Precious metals tend to thrive when two things happen: when rates are falling, and when confidence in the system is weakening. This scenario delivers both. A weak labor market introduces fears of a slowdown or even recession, while lower yields boost gold's relative appeal. It's not just about hedging inflation anymore, it's about preserving purchasing power when everything else looks fragile. And what about equities? The reaction is more complicated. On the surface, weak job growth should spook investors. Less employment often means less spending, which translates into weaker corporate earnings. But in the current environment, bad news is often treated as good news. Why? Because weaker jobs data increases the likelihood of a more dovish Federation. And for the last 2 years, markets have been driven more by interest rate expectations than by fundamental earnings growth. So here's the play: risk assets may initially dip, but could rebound quickly if traders believe the Fed will ease. Tech stocks, which are highly sensitive to rate expectations, may lead that bounce. However, sectors like industrials, financials, and small caps, which are more tied to real economic activity, might not fare as well. That's a divergence worth watching. Now to crypto. In this environment, digital assets become a pure play on liquidity. If the market senses that the Fed will loosen conditions, Bitcoin and Ethereum may surge, driven by speculation on a more favorable macro backdrop. But that rally may be short-lived unless there's follow-through in broader sentiment. Weak jobs plus sticky inflation could instead create a stagflationary setup, and that's not bullish for risk-on assets, including crypto. For sophisticated traders, the edge lies in understanding how fast sentiment shifts. A weak ADP number might rally gold and crypto, but if later data, like CPI or PPI, doesn't support easing, that narrative can reverse in days. This is where timing matters more than conviction. What does smart money do here? They don't trade the headline. They trade the follow-through. A weak ADP number should trigger position adjustments in fixed income and Forex. But the truly strategic moves will be in relative performance: gold versus the dollar, crypto versus stocks, long-duration bonds versus inflation-protected securities. And perhaps most critically, they stay flexible. This market isn't rewarding fixed opinions, it rewards fluid thinking. Especially when narratives can flip on a single data point. So, what looks like bad news at first glance may actually become a tradable opportunity. But only if you know where to look and what to ignore. In the next chapter, we'll flip the table. What happens if the ADP number comes in hot, say, well above 250,000? Could a strong labor market actually become the next threat to stability? If you're getting value from this breakdown, don't forget to like, subscribe, and share Money Minded, where every number tells a deeper story. Chapter 3, Scenario 2, Strong ADP, Job Growth Above 250,000. Now let's consider the opposite outcome. What if the ADP employment report smashes expectations, printing a headline number well above 250,000 new private sector jobs. At first glance, this seems like good news. More jobs mean a strong economy. Right? But in the current macro environment, strength is not always bullish. In fact, too much strength can become a problem, especially when the Federal Reserve is still fighting persistent inflation. Let's break down what a hot ADP report really means. First, it reinforces the narrative that the US economy is not slowing down. Despite over 2 years of aggressive interest rate hikes, the labor market remains resilient. Companies are still hiring. Wages may still be rising. Consumer demand might remain strong. All of that sounds positive unless you're Jerome Powell. Why? Because the Fed isn't just watching inflation on the surface, they're watching the structural drivers. One of the biggest is wage inflation. If businesses are still hiring aggressively, it usually means they're still raising wages to attract workers. And higher wages mean stickier inflation. So a strong ADP number signals that the Fed's work is far from done. What does that mean for markets? Let's start with bonds. A hotter-than-expected ADP print would likely push yields sharply higher. Traders will begin repricing the odds of future rate cuts, not downward, but sideways or even upward. In other words, the market will start preparing for the possibility that the Fed may need to hold rates higher for longer, or worse, consider another hike if inflation data doesn't cooperate. The US dollar would also surge. Higher yields in the US relative to Europe or Japan attract capital inflows, strengthening the dollar. For traders, this reinforces long dollar positions, particularly against low-yielding currencies like the yen. Then there's gold. A hot jobs report spells trouble for gold in the short term. Higher real yields reduce the appeal of non-yielding assets like precious metals. Add a stronger dollar, and you get a double headwind. Gold often sells off sharply after surprisingly strong labor data. This isn't about fundamentals, it's about flows and positioning. Equities? The reaction is more nuanced. In the immediate aftermath of a strong jobs number, stocks may pop, especially cyclical sectors that benefit from strong economic activity. Financials, energy, and industrials might catch a bid. But that initial rally can fade fast. Why? Because stronger jobs data reduces the likelihood of future rate cuts. That hits tech and growth stocks the hardest. And if yields spike aggressively, equities as a whole may come under pressure. So paradoxically, what looks like good economic news can still trigger a risk-off response. What about crypto? Digital assets like Bitcoin and Ethereum have become increasingly sensitive to macro conditions, especially liquidity. A strong labor report implies tighter policy for longer, which puts downward pressure on crypto markets. Bitcoin may hold better than altcoins, but the overall environment becomes less favorable for a sustained rally. The higher for longer theme is typically bearish for crypto unless accompanied by specific adoption catalysts, which this is not. Here's where the analysis gets even deeper. A strong ADP print not only changes near-term sentiment, it also reshapes expectations for the path of monetary policy. If the Fed was expected to cut rates in Q3 or Q4, those bets get pushed into 2026. That repricing can unwind weeks or months of market optimism in a matter of hours. More importantly, it puts the Fed in a no-win situation. If they respond by staying hawkish, they risk a slowdown or credit event down the road. If they ignore the labor strength and pivot too early, they risk inflation roaring back. Either way, the margin for policy error shrinks. So what should traders watch in this scenario? First, look at Fed funds futures. If the market starts pulling back rate cut expectations, that's your cue to rotate. Second, watch the 2-year Treasury yield. It responds fastest to shifts in monetary policy sentiment. A sharp move upward confirms that the market believes the Fed is tightening or staying tighter longer. Next, monitor gold's reaction. If gold holds steady despite the strong jobs print, that could signal underlying stress or safe haven demand building beneath the surface. Divergences like this often matter more than confirmations. Finally, stay alert to volatility. A strong jobs number doesn't always lead to immediate chaos, but it increases the pressure on the system, especially when it comes right before the official non-farm payrolls report. That's when expectations really collide with reality. The bottom line is this: strong labor data no longer calms markets. It complicates them. It muddies the outlook for interest rates, inflation, and risk assets. It forces investors to question whether the soft landing story is actually masking a much harder landing ahead. And that's why seasoned traders don't trade data in isolation. They trade the narrative shifts that come with it. In the next chapter, we'll look at a third, an often overlooked, scenario. What happens if the headline number is strong, but the quality of jobs is weak? What if it's all part-time work or wage growth is collapsing? That's where the real cracks start to appear. If you're finding value in this deep dive breakdown, make sure to like, subscribe, and share Money Minded, where markets meet meaning. Chapter 4, The Illusion of Strength, When Job Numbers Mislead. Not all job growth is created equal. Let's imagine a third scenario. The ADP employment report prints a strong headline number, say, 260,000 jobs, seemingly reinforcing the story that the US labor market is thriving. Stocks may rally briefly, yields tick up, and economists nod in approval. But then traders dig deeper. What if most of those new jobs are part-time? What if wage growth is slowing sharply? What if the gains are concentrated in low-wage sectors like hospitality, gig work, or temporary staffing? In this case, the market isn't being told the full story, it's being distracted by the headline. And smart investors know that when the details don't confirm the narrative, something's wrong. This is the illusion of labor strength, when job creation masks deterioration in job quality. And in today's fragile economic environment, it's a red flag with far-reaching implications. Let's unpack why. First, part-time employment rising sharply often signals stress at the business level. Companies may still need labor, but they're no longer willing to commit to full-time payroll expenses. That's not growth, it's flexibility born of caution. In fact, a surge in part-time jobs often appears just before the labor market begins to turn down. Second, slowing wage growth means workers have less spending power, especially in a high-inflation environment. The economy may appear to be creating jobs, but if those jobs pay less, or don't keep up with the cost of living, consumer demand will falter. Remember, the US economy is nearly 70% consumption-driven. If wage gains flatten while inflation remains elevated, real incomes fall. That's a setup for recessionary pressure without the usual warning signs. Third, sector breakdown matters. If job growth is skewed toward service sectors while manufacturing or construction jobs decline, that suggests structural imbalances. Economies need broad-based labor strength, not just more bartenders and delivery drivers. From a policy standpoint, this scenario puts the Federal Reserve in a bind. The headline looks strong, so cutting rates might appear premature. But under the surface, fragility is spreading. The Fed, afraid of reigniting inflation, might hold rates higher even as the consumer starts to break. That's how you go from a soft landing to a stagflation trap, where growth stalls, inflation lingers, and policy options disappear. What does this mean for markets? Let's start with equities. In this environment, the initial response to a strong ADP print might be bullish. But when the internals show weakness, part-time jobs, slowing wages, sectoral imbalance, the rally loses momentum. Investors start to fear that the strength is an illusion, and the sell-off that follows is sharper and less predictable. Bond markets may respond with confusion. On the one hand, job growth implies strength and higher yields. On the other, wage deceleration signals disinflation, which should lower yields. This divergence can widen the gap between short and long-term rates, a deepening yield curve inversion, which often precedes recessions. For gold, this scenario is uniquely bullish. Weak wage data and rising part-time work suggest economic stress ahead, while policy inaction due to misleading headlines delays the necessary easing. That mismatch creates uncertainty and distrust, two conditions in which gold thrives. Crypto markets, however, face a more volatile path. On the surface, hopes for future liquidity support could provide a tailwind. But if the Fed stays hawkish due to the headline jobs number, crypto rallies may be short-lived or erratic. Bitcoin may outperform altcoins in this kind of environment, simply because of its digital gold narrative. This brings us to an important point for traders. What's the divergence between market narrative and market action? If stocks rally after a strong jobs number, but bond yields and gold start rising together, that's a signal. It means the surface is not matching the substance. These are the moments where money is made, not by trading the headline, but by trading the contradictions. Here's what smart investors will look for in this scenario. Are job gains being driven by low-wage, high-turnover sectors? Is average hourly earnings growth stalling or reversing? Are full-time positions declining while part-time surges? What is the trend in temporary help services? These questions matter more than the headline. They determine whether the job market is expanding or deteriorating under pressure. The illusion of strength is one of the most dangerous narratives in markets. It invites complacency, encourages poor policy decisions, and blinds investors to rising systemic risks. So don't just read the number. Read the truth beneath it. In the next and final section, we'll pull it all together. Whether ADP comes in weak, strong, or misleading, the message it sends could be the loudest warning for what's coming next. If you're getting real value from this deep dive, make sure to like, subscribe, and share Money Minded, where the numbers are just the beginning of the story. Conclusion: the jobs report is just the smoke. Every month, investors brace for the next big data drop. CPI, PPI, NFP, ADP. We obsess over the numbers, the revisions, the headlines. But the truth is, most of what moves the market isn't the data itself. It's the narrative the market builds around that data. And the ADP report? It's not just a labor statistic. It's a mirror. A distorted one. It shows us not just where jobs are going, but what we want to believe about the economy. If the number is weak, we fear collapse. If the number is strong, we fear tightening. If the number is misleading, we fear everything. That's because behind every job created or lost, there's a larger question at play: is the system still working? The real story here isn't just about hiring. It's about confidence. Confidence in central banks, in policy, in growth, in the value of money itself. When ADP prints weak, gold rallies. Why? Because gold doesn't trust the system. When ADP prints strong, the dollar spikes. Why? Because markets fear that the Fed will overreact. When ADP misleads, volatility surges. Why? Because no one knows what to believe anymore. The smartest investors don't just trade data. They trade dislocations. Moments when the narrative breaks from the numbers. When the truth is in the tension. So what does this mean for you? If you're an active trader, this is your edge. Understand not just what the number is, but what the number means in context. Be 2 steps ahead of consensus. Look for divergences between bonds, gold, equities, and currency. If they're not confirming each other, the market is confused, and opportunity is near. If you're a long-term investor, the lesson is even more important. The job market may still look solid. But when growth starts to concentrate in low-wage, part-time work while inflation eats away real incomes, the foundation is already cracking. That's not visible in headlines, but it's there in the data. And if you're just someone trying to understand what's next, the lesson is simple. Don't take the numbers at face value. Understand who benefits from the story being told. Because every market shock starts the same way, with a story that seemed too convenient to question, until it collapsed. Right now, the job market is being used as a shield. A tool to justify tight monetary policy, slow fiscal reaction, and rising inequality. But data, like trust, is fragile. One crack, one unexpected number, and the illusion can vanish. This is the game. And this is the risk. The job report is just the smoke. But what matters is the fire underneath it. And in today's global financial system, that fire is spreading through debt, through distrust, through disconnected policy. On Money Minded, we don't just follow the numbers. We follow the undercurrents. We ask the hard questions. We expose the contradictions. And we prepare for what most investors won't see coming. So if you found value in this video, if it gave you a different perspective, a sharper edge, do 3 things right now. Like this video. Subscribe to Money Minded. And share it with someone who still thinks the job numbers tell the whole story. Because in a market like this, the truth is never on the surface. We'll see you in the next one.